even $1 a day can actually make you $1 million.
$365 a year, that would be almost $2 million.
Our guest today is Paul Merriman, who is a legendary voice in the investing world.
The stock market is risky.
There'll be lots of years the market loses money. More than you want, I promise. And I'm telling you, I've got 60 years of experience on this one. Returns go up and down, but expenses go on forever.
He's the founder of the Merriman Financial Education Foundation and has spent decades helping people invest smarter through low-cost index funds.
$100 invested in the S&P 500 since 1928 would have grown to nearly $1 million. For a beginner, can they just do S&P, or to get that extra return, what can they do?
There have been 3 times the S&P 500 has lost half of its value. I have a very strong belief that the future will look basically like the past.
A lot of our listeners are in early 30s or late 20s. Where can they invest money for their kid?
As soon as possible. And it's not a simple decision because
From his famous 2 funds for life approach to his focus on long-term compounding, Paul's insights have helped countless DIY investors build lasting wealth.
there's big risk in individual companies. Nobody should put money into individual companies. They should put them into a
Hello and welcome to the Compounding Project podcast, where we talk about taking small steps to become healthy, wealthy, and wise. I'm your host Satish Kajula, and this episode is all about wealth, especially index funds.
Thank you very much. It's wonderful to be here. And I will tell you, you have got a good thing going. I went to your site and I was very impressed with the work you're doing. I want to wish you all the best.
Thank you so much, Paul. I think so. Before I hit record, I said, I've been a huge fan of your work, and thank you for all the stuff that you do. And most of your content, if not all of your content, is for free, and which says the fact that you're doing this just for selfless reasons, right? Yeah, thank you so much for all the work that you do.
Thank you. Thank you very much.
Right. So yeah, I'm going to dive right in. So you often call saving early as $1 million decision. So for young investors who can only save a little, so how can they truly understand the impact of starting early?
Well, if we look at just the pure math of putting money aside and having time on your side, then we can start from birth. We can put $1 away from the time a child is born. And in theory, somebody could put $1 away a day through age 65. And what is so fascinating is that with that $365 a year for 65 years, if you got a market return like the S&P 500, the theoretical 10%, that would be almost $2 million. If we waited until that child is 10, so we missed 10 years of $365, that amount of the value at age 65 is about $750,000. You've lost over $1 million because of that $3,650 shortage early on. And then finally, so many parents and grandparents have it in their mind that they're going to help their grandkids or their kids when they reach 20, when they start making money. Well, the reality is now, if we wait until age 21 to start putting that $1 a day away, that $365 a year turns into about $260,000. So there is no question, just looking at the pure math, the compound interest early, more years, it's all the magic one could ever want.
This is so fascinating because, whenever I started, the first time I came to know about compounding was when I was 25 years old, right? So, I learned about compound interest during school years, but I thought it was just to pass my examinations and that's it. I never knew that you can apply that in real life. Yes. So that's one of my biggest regrets, if any, because, if I had known the power of compounding a few years, if not a decade early, that would be like massive. But yeah. So what you said is like, if you save just $1 a day and invest that money, you could very well become a multi-millionaire when you're age 65. That's so fascinating.
Well, and don't forget, life does not end at 65. So if we really want to see the true impact of saving and investing, I think it's represented by what we take out of our money in retirement. That's a reward for having done it. And then we pass away at some point and we leave it to others, and then they take money out of it. So I try to get young people, when I'm teaching college kids, to think in terms of, this is not a one-generation business that we're trying to grow here. This is a multi-generation business, and it's not a bad idea if you can get your kids involved in that business.
For sure, yeah. So you can create not only wealth that lasts for one generation, but like multi-generation, just because of the time, right? The time is in your favor. I mean, I'm a parent. I have a 2-year-old. So after I saw your example, I thought, okay, I'll start doing it. So what are the practical ways? Where can they invest that money for their kid? Which accounts should we consider?
Well, there are a number of different tax considerations, but leaving taxes out of it for a second, at least in the beginning, because most kids do not have the opportunity to legitimately earn money when they're less than a year old. Now, I once hired a grandchild to be on the cover of a catalog that I produced, and we paid him to be on the cover, and we were able to put that money into an IRA. But I think what we can just think generally in terms of is whatever money we can put aside early on before the child is earning any money, we do that in our own name if we want to maintain control if we want to. And it could be a Uniform Gift to Minors Act, but let's remember that money becomes that kid's money at 18, more than likely. You may not exactly want that to be the outcome, so you could keep it in your name, accumulating the value, having it earmarked for that child's IRA, that Roth IRA, as soon as possible. So when our last grandchild was born about 3 years ago, my wife and I we fed the kitty right then, gave her the money for her retirement, and that money was invested in equities. We want it to be growth. And also, by the way, we want her to be able to see the impact of putting that money in 2 different equity asset classes, because I am hoping that by age 18, she understands what investing is about, and she'll have 18 years of seeing what that money did. The S&P 500 and small cap value. Some years it's the S&P, some years it's small cap value. And what I'm hoping is she'll look at that as a strategy that then she can use for literally the rest of her life. And so I think it doesn't have to be a lot of money. It could be hundreds of dollars. The lesson will still be taught. And of course, as you know with your child, and I know with my children and grandchildren, the key is going to be, can they keep their bloomin' hands off the money? And so we all have to prepare for ways to try to keep that money in place and protect it every way that we can.
Interesting. So a few details, like a lot of listeners have just are in 30s, early 30s or late 20s. So they either have a kid or they're planning for a kid, right? So you said can we open an IRA even like when they're like 1 or 2 years old, or can we do that?
Well, actually, at this point, other than what the government might offer people, some sort of an incentive to put money aside, you really, for most cases, you have to have earned income. Okay. And so the question is, basically, what do you do with the money until they've got the earned income so you can get it into the Roth IRA as soon as possible?
Got it. So I think the practical way would be until get the earning term, just open an account in your name,
Yep.
and then start contributing in, and then once
Yes.
yeah. So they become adults. You can just transfer that money, and then at least by then they understand the power of compounding, and then hopefully they'll stick to that money, and and then ride it. Right. That's
And
good.
by the way, I'm going to guess that your child is going to know about compounding before he or she is 25 years old. I mean, think of the implications of what we have to offer to the young people in our families to give them the lessons that are really in their best interest. And of course, you and I also both know that there are a whole bunch of people who do not want them to do what we want them to do. And so we have to do everything we can to prepare them for the reality that whether it's Amazon or Google, they're all coming after you. Apple, they all want your money. And what we hopefully can do is instill in young people a real commitment to this foundation. It's not that we don't want them to have fun with their money in life, but not this money, or if we're going to have fun with it, it should start at about age 65 or 70 rather than 5 or 6. So anyway, it's all an interesting challenge, and it requires management, but the management decisions are not all that tough.
We'll get back to the episode in just a few seconds. 94% of people who watch this channel haven't subscribed. If you're enjoying this episode, can you do me a quick favor and hit that subscribe button? It helps the channel grow and brings in even more guests so that I can provide more value to you in the future episodes. Now, back to the episode. Got it. Yeah. So so I talk a lot about, how to use the power of compounding to earn millions and, like multi-millions, right? Yeah. So the one thing I always get, when it comes to questions, they always say that I don't have enough money to save, right? So, and looking at just your example, you don't have to make or save too much money in the beginning to make those millions in the future. So you mentioned even $1 a day can actually make you $1 million if you're consistent for over a 65-year period of time.
Yes, and I do also have done studies starting at age 22, putting away $100 a month, which I think most could do if they wish to. We know that there are countries around the world where people make less than we do here. And we also know that those people who may only make a small fraction of what we make are able to save money. They may not invest it in the stock market, but they are putting it aside for the future. And that we, unfortunately, have been raised in a society that is focused 99.9% on consumption. And so this is not an easy thing for people to get the idea that I should do without, that I should sacrifice, that I should put money there until I'm 65 or I'm 70. In fact, it is not unusual to find a lot of young people don't even think they're going to live that long. So it's a mindset, and I find it fascinating that so many engineers get it. And the reason I think they get it is because they get math in the first place. And I think we fail a lot of young people in not at least taking the time to teach them the math of investing, which is why I'm working so hard to teach young people at the high school and the college level about these very simple truths and the impact they should have on their financial future.
I love that. I think young people, if they know the power of compounding, and that's just massive impact on their whole life. Because if they figure their money, a lot of other areas could be optimized also, right? Because money touches almost every aspect of a life.
That's right.
Believe it or not. But if you have that money like financial freedom, then you can pursue your dreams, you can pursue your passions, and you don't have to sacrifice your time, for money, right? I love that. I love that you're talking to young people about the power of compounding and the power of like starting early. I love that. So we'll dive to the second part where you have often shown that $100 invested in the S&P 500 since 1928 would have grown to nearly $1 million versus just $10,000 in bonds. So can you tell me like what is the biggest takeaway from this particular lesson?
Well, the first thing is that $10,000 has something very special about it, and that is that it is achieved without any risk, because that was a government bond that we were putting the money into. So for people who don't want to take any risk and they want to make sure that money is there when they need it, that bond is a wonderful place to put money. On the other hand, if you are putting money aside for the future, that $100 is going to run right in to inflation. And inflation is going to try to, or at least historically, has virtually gobbled up almost all of that $10,000. So you're left with almost nothing after inflation, and we haven't even talked about taxes. So then we look at stocks. Now, stocks are terribly risky by the day or by the year, or even you could say by the decade. Individual companies are risky. In fact, the history of public companies is that over the last almost 100 years, half of them didn't make any meaningful money for the investors or virtually went out of business. So yeah, there's big risk in individual companies, which is why nobody should put money into individual companies. They should put them into a diversified portfolio. And lo and behold, it does not go broke over time. As a matter of fact, and this is what's so wonderful about equities, over the last almost 100 years, the worst 40-year return for the S&P 500 is about 9%, 8.9% for people who want to be rounded off exact. And the best 40 years was a compound rate of return of 12.5. Now, that's a huge difference. But interestingly enough, when you adjust those returns for inflation, they're almost the same, because one was achieved in a relatively low inflation environment and the other was achieved in a relatively high inflation environment. So it looks like, whereas with bonds over the long term, there's almost zero return, but boy, are they safe, okay? On the other hand, with stocks, it appears as if somewhere around 6, 7, 8% is a legitimate after-inflation return. And if you're able to get that over your lifetime of saving and do it with very little risk of not winning, I mean, if you're in a diversified portfolio of these companies, almost is guaranteed, but we can never say guaranteed because we have no idea. I'm sure when they issued the Confederate bonds, people thought they could cash those Confederate bonds in someday. And unfortunately, no, it didn't work out like that. So it is for the long term a bonanza to be in equities if you're willing to stay the course for those very, very rough short-term periods. And if you're not ready for that, the odds go way down that you're going to make it for the long term. But if you are ready for it, and by the way, isn't this the way life really is? If we have practiced things and found out how to deal with failure, short-term failure in life, we get better at it, and we learn to be a doctor in surgery someday. But you don't get that overnight. You've got to learn and experience. And what you and I are trying to do is to give people that experience without having to actually live through it. So that's what all the numbers that you and I show, that's what it's all about, is to paint the picture of what it's likely to be like in the future.
Hey, before we get back to the episode, I've got something special for you. I spent the last 3 months putting together my top 100 life-changing books. The link is in the description, and I would love for you to check it out. Now, let's get back to the episode. Yes, exactly. So growing up, I think the only advice that I received growing up was to save money, and I was not told what to do with that saved money. So I told you, like, I was born and brought up in India, and in India as a nation is actually very frugal. I mean, it's not like a generic statement, but we, from growing up, like from the childhood, we are taught to save, like we are taught to save money. But the maybe unfortunate part is we're not told what to do with the saved money. And growing up, I was told that stock market is risky and don't ever try to invest in the stock market because they said it's gambling. It's like my parents and my relatives, they said, they have never met a single person who made money in the stock market. So
Wow.
that was my mindset. You can imagine like what was my circumstances growing up. So I thought like stocks were risky, and then I did not invest a single dollar. And what happened, like when I turned 25, when I started making money, so I had some money. So I was like, okay, what should I do with the saved money? So I was just thinking about it, and I came across a few books. And one of them was Stocks for the Long Run by Jeremy Siegel. And boy, that book changed my mindset forever. And just like you told, there is a chart in that book where, it shows the returns of stock market, like in 1 year, like how volatile it is, like, how much it went up and went down. And then over 5 year, that standard deviation decreases, the volatility decreases. And I believe it's like, there was never a period in the 20-year period for the past, I believe, 200 years where stock market lost money. Never. Like in the 20-year period, there was never a period where the stock market lost money. And that example made sense to me because I thought like stock market was risky. I thought it was gambling. But looking at the data, it's completely telling a different message where, stock market is not risky over the long term. So can you have more thoughts?
I do have a thought on that. And to add one more variable that makes it even better is for young people, if they are dollar cost averaging into the market every month in a 401k, the very best thing that could happen to them in the early years is for the market to go down. They should be celebrating that decline because now their money is buying more shares. Now, I'm not happy if they're buying Enron or Eastern Airlines or Washington Mutual. That's not what I've got in mind, but you're putting money into a target date fund or the S&P 500 or the total market index, because even if we go back to 1929 to 1938, if you dollar cost averaged into that market over that 10-year period, you were up about 16%, 16% or more, maybe it was 60%, but anyhow, you were up because you were buying those companies when the market was struggling. And that is why for young people, if they can't write a $10,000 or $100,000 check, but they can write the 100. And if the 100 is buying cheap shares, that's good, not bad.
That's good. Yeah, it's good. I feel like, very young age, right, in 20s or 30s, right, I feel like, we are at an advantage because let's say if the stock market is going up, you're making money, and the stock market is going down, you're actually buying more shares because, you're getting it at a discount. So it's like if the market goes up and down, I'm happy, right?
Well, and not only that, and what a lot of young people don't know, and there's no reason why they should, is that if they look at somebody like me who did well in the stock market over a lifetime, from saving and waiting. And so I waited until I was 70 to really finally cash in, if you will, and call it quits, and started working for nothing with my foundation. And here's what I know. I know that when I was your age, this is what I tell the young people in their teens and their 20s, it was very expensive to buy and sell a stock. There was no index fund. There was no Roth IRA. There was no target date fund. Everything was built to benefit Wall Street, not Main Street. Today, This is the thing that makes me so hopeful for young people if they just kind of do the right thing, is that the system is built with broad diversification, low expenses, low turnover, low taxes, and even no taxes. And so you, as an investor starting out today, should do a lot better than I did, because I had to fight I'd go into the wind to try to make money. You got the wind from behind, and that's what I'm excited for you about.
That's great. I believe in 1976-78, when Jack Bogle founded Vanguard, people were laughing at him, like, why would somebody want to buy an average, like buy the index? Why can't you make more money?
It was 1976, and the other thing that happened in that year is Charles Schwab started the discount brokerage industry off, and there again, it was a bonanza for the do-it-yourself investor. And it's interesting because you and I, in the work that we do, what we would really like to have happen is that people will learn what they need to learn to do it themselves for the rest of their lives. Because you and I, again, we know the math. We know the implications of not paying somebody like me to manage your money. Because when I was a money manager, they paid me 1% a year. I don't want you to pay me 1% a year. I want you to keep that 1% in your family, not mine.
Interesting. And also, like, I think investing is the only place where, you don't get what you pay for, right? Because, let's say if you want the best surgeon, like, if you want to get a surgery, you want the best surgeon or you want the best lawyer. But when it comes to investing, like, if you pay high fees, you may not get the high value. So can you talk about that concept, like fees?
Well, that's the great, a couple of Bogle quotes that you've just brought up in my mind. One is that returns go up and down, but expenses go on forever. You are always going to be paying that extra 0.5 or 1%. As a matter of fact, I could make the case that many people will end up paying probably an extra 3%. They'll lose 3% a year over a lifetime because of decisions they made that were built, in a sense, to have that happen. By the way, that's because somebody else picked up a lot of that money along the way. But yes, expenses, that is the worst case of compounding I know, because you're compounding against you. Now, that's one thing. And another thing Bogle said was, let's see, about you just said it, that in investing, we get what we don't pay for. So if you pay less, you get more. And that's hard for us to believe because we are brought up believing that we're going to get more if we pay more. That is not true when it comes to investing. Now, having said that, I don't want to forget that people do win lotteries. So, yes, some people will pay more and get more, but that is going to be against the probabilities that at least all the statisticians know about.
For sure, yeah. I can't rely on me winning a lottery. I can't risk my financial life on that.
That's right. You got it.
Now, I think so. We established the foundation, right, when it comes to like young people to start early because we know how the compounding works, right? And then also we established the case for having stocks in the portfolio, especially when you're young and not bonds, right? So is on this topic, like, is there a place for bonds, for when can they start thinking about bonds?
Well, let me talk about two people. I want to talk about people like myself who are retired. We have enough to live on, and we could probably have all equities, but I know my risk limits. I don't want to give back 80% of what I have or 50% of what I have over the next maybe 5 or 10 years, or maybe a year that I have to live, whatever it becomes, it will be. But I do also want to realize I have obligations with the money that we've saved because we've committed to Western Washington University that when I die, they're going to get more money from us. And so I want that number to be as big as I can have it be without having it be much less because I continue to take too much risk. So old people oftentimes will have half, 60%, 40% in equities, but we're 50-50 for what it's worth. We're 50-50 and comfortable with that. On the other hand, if you were in a target date fund that is being managed with your age in consideration, typically the target date fund for somebody my age will have 70 to 60% in fixed income. Now, that's old people, okay? But let's talk about young people. What if I sat down with a young person and I found out that they really inside did not trust the stock market, not enough to put all their money in the stock market, that they believed it was gambling, but I convinced them, I showed them all the numbers, and they finally, as salespeople, can wear you down, okay? So I wear her down. Let's just assume that. And she says, okay, but not everything. Okay, not everything. I'll compromise with you. Let's see how you would do if, over the rest of your life, you put 60% of your money in stocks and 40% of your money in bonds, and you know what the textbooks would say, that you will probably get 90%, 85 to 90% of the return of the S&P 500. That ain't hay. That's not bad. As a matter of fact, I think that for a lot of people, even an 8% return for their lifetime would be a good return. So I'm not scoffing at getting 85 to 90% of the S&P 500. And when things are bad, you're still going to lose money, but it will be a fraction of what you're going to lose in the stock market. And that hopefully you should be able to live through that. And you're a young person. You don't have any money at risk right now. You're only going to be putting a small amount of money. So let's do this for the next 5 years. Let's see how you feel, because number one, you may decide, hey, we went through a bad stock market and I made it okay. I'm willing to put more in stocks in the future. Or you might say, it was a rough ride, but I think I can take that for the rest of my life. Because even if we could talk a young person who says, I don't trust the stock market, into a 60-40 or even 50-50, the long-term return is pretty doggone good compared to that safe instrument they want to be in, that bond. I mean, that's not in their best interest, but I understand why they think it is, and it won't shock me to find out their grandparents are the ones who told them bonds are a good place to be, because parents and grandparents sometimes give the most terrible investment advice. So there you go.
Yeah, I think that's your also advice that I got when I was growing up. There are this CDs, like certificate of deposits, where I believe it's you get a fixed return on how much, like for a length of period, maybe like 3 years or 5 years, right? And we were told that's the best investment. So that's growing up, that's the investment advice that I got. So coming back to what you just said, so you mentioned, okay, so for young investors, the best thing would be to go all in on equities. Let's say if you have that appetite for risk, right? If not, you can still go for a 50-50 or a 60-40 portfolio, and still you would be okay. Like you'll get like 80 to 90% of what market is getting like this. But it's actually, we should think about like stocks as the one that makes the money in our portfolio, right?
Yes, and for what it's worth, Satish, we have pages and pages of returns over 50 plus years, where you can look at a 60-40, a 70-30, a 40-60, a 20-80. You can look at every combination of fixed income and the S&P 500, if that's what you want to look at, and see how you would have done. And I think that while it's not the same as living through it, being able to see that over time is an education that at least we hope will make an impact on what it's likely to be like in the future.
Understood. Yeah. So we're going to talk about like way to invest our money and how to optimize our portfolio later. So I have one quick question that I want to address. So far we have been talking about young investors, like people who are in their 20s or people who are in their 30s. So, but I've also encountered a lot of few people who are in their like 40s or 50s, where for the first maybe 10 years or 20 years in their career, they haven't thought too much about money. Like they were making money and then they didn't realize they were living paycheck to paycheck, but they were just comfortable, right? They had like luxury houses, luxury cars and stuff. Maybe in their 40s, they realized that, okay, they are maybe just 20 years or 10 years away from retirement. And that's when they start thinking about money. And as you know, like time is the most important factor when it comes to, building wealth. So what advice would you give them? Like, is it too late to start in 40s or 50s, or how should they be thinking about investing?
Well, it's not too late. There's plenty of time. The question is, at what rate do they need to save, and with what amount of risk are they willing to take? Because it's not a time to make some big mistake here, because at this point, when I think about young people, this is the worst advice I know a parent can give, but it's what they give. They will tell you, you are young, you could invest, and if you lost everything, it won't matter because there's plenty of time to catch up later. And you're going to learn how to invest and swing for the fence. I mean, they give terrible advice because in reality, while they should all be in equities, it should not be a high-risk commitment. It should be a low-risk equity commitment with a broadly diversified portfolio. Well, you see, you got the same thing with the 40 and the 45 and the 50-year-old. They're just getting started. And yes, they've got to obviously start saving, and they probably need, and I mean virtually every one of them would probably benefit from this, sit down with an hourly financial planner, not somebody that wants to manage your money. You don't have any money, and figure out, who am I as an investor? How much risk am I going to be willing to take? How much am I going to be able to save? What do I do? Obviously, you weren't budgeting for saving before, but now you've got to start budgeting for saving. How do I do that? Well, you need to get some professional help. Now, I can tell you what I wish I could do. I wish I knew how to put all the information on the website that would allow you to be able to simply go there and answer some questions, and it would tell you exactly what to do. I don't know that I'm that good at what I do, because I know when I was an advisor, if I even had a couple that came in and I interviewed them, one might be very aggressive and one might be very conservative. How do you address that? Sometimes you talk to people for hours to work that out, to figure out who they are. We're talking about building a business. I look at investing always as building a business. And so this business you're about to build is supposed to be, in essence, sold in pieces when you get to retirement. And so I want to make sure you build the right business for who you are, because it may be, if you're planning to work till you're 70, and I don't know how realistic that is, that would be part of the conversation. But if you think you're going to work until you're 70, it may be you should be all equities when you're 40. And you should be all equities because you're no different than a 20-year-old. If for the first 5 or 10 years the market goes down, that's okay, actually, because you're getting a chance to position yourself in these companies that are likely, probably, hopefully going to do what you want them to do, and they have no obligation to do that. So there are important decisions, but the first one is, how aggressive can I get in my saving? Because you got to push that envelope as far as you possibly can. It may mean, for example, that you've been given a bunch of money to your kids, and that's one of the reasons that you don't have what you need today. Maybe you've been given money to charity, and that's one of the reasons you don't have what you need today. Well, maybe you need to reevaluate that. I have seen people, when I was an advisor, when people were really big givers and not good savers, I would try to get them to reconsider the timing of their giving, because put it in your will, for crying out loud, that everything that left over goes to the church. But if you're given everything that you should be saving to the church, are they going to take over for you and help you when you can't pay for what you need to pay for in retirement? And the worst thing you can do, I think, is to have to go to your kids and say, I did all I could to take care of you, got you through college, and it turns out your mom and I just aren't making it. And the kids say, God, I'm sorry, Pops, but we don't even have the ability to save. As a matter of fact, you were not a great teacher. The worst thing, I think, would be to ask your kids for help and the kids say, sorry, we can't help. And yet you did. And so there's a compromise, and almost everything you think about in terms of investing is about a compromise. And also, I think an important thing for people to realize about investing, every important step I know about successful investing is defensive, not offensive, defensive. So offensive when it comes to saving, defensive when it comes to investing.
Love that advice. I think you said beautifully, we don't want to depend on our kids for money, because at that time,
right,
even they will be struggling to save, right? Because, young people, they'll be struggling to save. And then, when we put our burden on them, it will be a huge burden for them, because, they not only have to take care of us, but also build their financial future, right? I think it's, what you said makes perfect sense. I hope people who are listening, even if you're in your 40s or 50s, it's still okay, because you have 10, 20, 30 years of working, that you can still use that money to build a strong foundation for your financial wealth. All right. So now I think, we established, as a recap, we established the power of starting early. We established the power of stocks in portfolio. Mm-hmm. And then now I'm coming to the most important part of this whole conversation, where to invest, right? I mean, so for me, I've been investing for 10 years. Until lately, I've changed my investing strategy based on your work, which we are going to talk about. But I'm a huge, huge fan of Warren Buffett. And then Warren Buffett said, when he dies, he wants, I'm paraphrasing this, but he said, when he dies, he wants his funds to be 90% in S&P 500. He prefers Vanguard, and then 10% to be in bonds. And that's it. That's the advice that he said he would give to anybody, right? And then so at that time, I learned that advice 10 years ago, and I've been doing S&P 500 all this time. And I have VTSX also, which, JL Collins talks about, right? So that's my majority, if not 95% of my money is in either S&P or a total stock market index. So, but you have an interesting take on how you can outperform S&P 500, right? You have data to back that up. So can you talk about your thoughts on can we, for a beginner, can this just do S&P, or to get that extra return, what can they do?
Well, first of all, we all have to decide, what information do we trust in making a decision? Whether it is a personal decision, deciding to marry another person. I mean, think of all of the things that we consider when we say yes to the proposal. And it's not a simple decision, because there are a lot of times we've had together. Maybe part of the times were really good, and some of the times are a little testy and a little different. I mean, there's all sorts of things that we know about the past in our personal lives and the relationships that we have. My relationship in this regard is with numbers from the past. I have a very strong belief. Not everybody believes this. I believe that the future will look basically like the past. Now, when I say that, I am talking about the returns on investments. And what I'm talking about is this, that the last 2 years, the market was up 25%. Okay? Now, is that amazing? Well, not really. I mean, I know that from 1995 to 1999 that the market compounded S&P 500 at 28.5%. 28.5%. And it did that for 5 years. And I also know, by the way, that the S&P 500 compounded at 17% from 1975 to 1999. Whoa! But wait a minute, from 2000 to 2025, it compounded at 8.3. Wait a minute. Now I got a problem. What do I expect I'm going to get from the S&P 500? Well, as I look backwards, and this is what you'll often hear, well, the market makes about 10%. Well, sometimes it does, and sometimes it doesn't. From the 25 years prior to 1975, that's about what it made. So that probably is not an unrealistic expectation, but what's with this 8.3% it's gotten for the last 25 years? Has something changed? Well, I don't really think so. What I cannot tell you is what the sequence of returns will be. In other words, if it goes up 11% this year, I'm going to say, so what? What does that tell me about next year? It's nothing. What does it tell me about the next decade, the next 25 years? Nothing, unfortunately. But I can see that the market has these ups and downs, and about 25% to 30% of the time it goes down, and sometimes it goes down a lot. And so when I put all of that together, what I trust the most is I've got data from the academic community, not from Wall Street, but from the what I call University Street. They have looked at the price of every security, every public company since 1927, 28, some of it 26, and they have tracked it. And they've broken it down into big companies and small companies and growth companies and value companies. And every time there's a different kind of a company, they very carefully identified that different kind of company. What is it we see about large companies versus small? Do they go up and down together? No, they don't go up and down together. And fortunately, if you go on my website and look at a quilt chart, I can show you every year since 1928. How did the S&P 500 do, the big companies? How did the small companies do? How did the growth? How did the value? How did it work if you just took 25% of each of the four? I can look at those years one at a time since 1928. And it's fascinating to me because there is no pattern. I cannot say, well, for 5 years, one is at the top, and the next 5 years is at the bottom. None of that. What I have to say is, while I believe that the returns will be the same without trying to pin down the sequence of events of those returns, what I do believe is there'll be lots of years the market loses money. More than you want, I promise. And I know if we just go back the last 55 years, that there have been 3 times the S&P 500 has lost half of its value. Now, that's a big deal if I had all my money in it and I was retired. On the other hand, maybe for a young person, it's okay because you're going to pick up those bargains for the long term. But I find this, and the academics has convinced me, and I learned this in 1993 or early 94, and I have been preaching this since then, that the work that they've done is meaningful. And I can't say trustworthy because I can't put the word guarantee on it, but I can say this. It's better than any piece of information I've seen that has come out of Wall Street, in that they don't make false promises. They won't tell you when you're going to get better returns. As a matter of fact, Wall Street likes to say, over the last 10 years, we were up 19% a year. Get on board. No, not get on board. It probably should be, and I certainly wouldn't buy those because they're probably going to go down next. University folks don't do that. They have people who peer review their work. And if they include any hot air in their work, they're about to be taken out behind the work shed and taught a lesson because you're not allowed to do that. Now, having said that, I'm sure they do from time to time, but overall, my trust is in what the academic community has found. And even then, when I apply it to my life, it turns out it doesn't work out quite as well as when I first heard about it. But a lot of people have heard about it. And so what do I know? I know that small cap value over the last 25 years has made about 3% more than the S&P 500. And that's because value historically, and those are out-of-favor companies, pay a premium historically because they're more risky. This is not like it's a miracle. It's just like stocks are more risky than bonds. So it is not a miracle that stocks are expected to make a better return. If they didn't make a better return, it would be stupid to put money in them. So what do we know? We know that not only for the last 25 years, but the previous 25 years and the previous 25 years, that small cap value gave a better premium than the S&P 500. And what is fascinating about it, and that I just love about it, is they don't go up and down together. So there'll be a year, like this year, sometimes it's kind of U.S. and international. This year, small cap value isn't doing great. International small cap value is knocking the lights out. And so it's all about diversification and getting, it's about having massive diversification, by the way. I want you to have the diversification that I have. My wife and I have over 12,000 companies in our portfolio. And you too can have 12,000 companies with a $100 investment. And you can spread it. We couldn't do this when I was a young person, but today you can go to Fidelity and you can actually buy partial shares of, if you wanted to, 10 different mutual funds, ETFs. And so my view is that it makes sense to add some small cap value to that S&P 500. I'm not saying to throw the S&P 500 out. I'm just going to tell you that from what I know about the past, that if you put a little bit of small cap value in, whether you're doing the S&P 500 or a target date fund, you are likely to pick up an extra 0.5%. 10% could lead to a 0.5%. 20% could lead to 1%. And I got to tell you, anything I can do to help you increase your return by 1/8%, I'm looking for it right now. Always.
Like 0.5% or 1% in the investing world, it's insane. Like it could be $1 million decision over a long, like 40, 45 or 50-year period, right? So
it is. Yeah. I mean, if I could just give that number, it's important. If you put money away over a long period of time, like 40 years, and you can add an extra 0.5%, and you put away, let's say, $6,000 a year, that over your lifetime, including the lifetime that you take money out and what you leave to your charities and children, should add about $1.5 million to your kitty every 0.5%. So if I could find 0.5%, that would be theoretically twice 1.5. But it turns out if you can find it, not only an extra 0.5%, but you're compounding the extra 0.5% of the other 0.5%, it isn't just twice 1.5, it's 3.5 million, because you were doing better on the first 0.5%. I mean, everything. And this is the thing. And I'm telling you, I've got 60 years of experience on this one. When I was a stockbroker for a couple of years back in the 1960s, I sold mutual funds, and those mutual funds had an 8.5% load. 8.5% load. And not one person ever asked me, what does that cost me over a lifetime? People buy mutual funds and they have high expenses. They don't ever ask, what's that high expense going to cost me over a lifetime? Well, I'm just telling you, if you follow the math, every 0.5% is going to contribute for a young person probably another $1.5 million over a lifetime. And that does not include the money that your kids will make on that money after you're gone.
Wow. I'm glad actually I'm part of this investing world right now because, fees are minimal, right? And then there are no loads, no commissions, right? I mean, I can only imagine how difficult it would be to build wealth back in the day because everybody's trying to get your money and then you might end up with less money. So I'm very glad we talked about small cap value. So for young investors, let's say, so the advice that I have been giving so far is like whenever somebody approaches me, I say it's very hard to beat the market consistently. Instead, buy the market. So what I've been telling people to do what I do, just buy an S&P 500 or a total stock market index fund, and then do dollar cost averaging, and then you will be good, right? And then so now you mentioned, let's say if you add small cap value, you could be, let's say if S&P 500 gives 10%, you could be making close to, you said 0.8%. Let's keep it at 1%.
No, if you did 10, we've got a table there, a table that shows the S&P 500 on the left every year since 1970. And then it has a whole bunch of rows, and on the far right is 100% small cap value since 1970. And in between are the increments in 10% value. So if you wanted to add 10%, it will show you what was the return every year of 90-10, of 80-20, of 70-30. So you can not only pick the amount of that you have in there, but you will also see the additional risk. And here's what I promise you. You will be shocked at how little the additional risk is when you add small cap value, because it doesn't go up and down together. As a matter of fact, we have one table that we show that shows the S&P 500, and it looks at all of the good years and the bad years, and it shows you what the average loss was in the bad years, and then it adds up all of those losing years. Then it shows S&P and small cap value, and it turns out that the combination of the S&P 500 and small cap value had a lower accumulated loss total than the S&P 500 by itself. And that's not because small cap value isn't risky. It's because it doesn't go up and down together, which is the whole idea of having 500 stocks in the S&P 500, is because you don't want them all to go up and down together. And it's the same. The academics will say you're not doing anything different when you add small cap value to the portfolio. You've just increased the diversification, more companies, but of a different asset class.
All right. So yeah, whenever I hear this advice, to add small cap value, for the first, my initial impression was, maybe 6 months ago, my first thought was, I own a total stock market index fund, which means, I own large cap, mid cap, small cap, right? So I have a mix of everything. So why should I add small cap value if I have already small cap in my total stock market? So what would you say to that?
Well, that one's an easy one. What you get in the total market index are a couple of things that are a challenge. One is, historically, small cap growth has not done as well as small cap value by a lot. And so what you get in the total market index is about half of that small cap that you get is in fact growth. That's the first thing. The next thing is that small cap exposure you get in the total market index is so small that in a cap weighted portfolio, and I'm going to tell you about something I'll bet that you've never heard, because I've rarely said this, and nobody ever told me this, what I'm going to share in a minute. But before I get there, and I hope I remembered, the reality is that the small cap is so small that it does not help do anything to the long-term return of the portfolio. So if we go back to 1928, what do we know? We know that the S&P 500 actually has a 0.1% better compound rate of return than buying the whole market. We also know, if we look at the last 25 years, the difference is 0.1% in the favor of the total market index. It has compounded at 8.4. The S&P 500 has compounded at 8.3. Now, what is the impact of value? Well, I can show it to you in two ways. I can tell you that over the last 25 years, that small cap value, using the kind of a small cap value index we think you should, because they're not all created equal, just like not all S&P 500 funds are created equal. But the small cap value ranged from 10.1 to 10.7, as opposed to 8.3, 8.4. Now, it's not the premium I wanted, but, we could say we never get what we want. And I'm sure the people who got 8.3 or 8.4 for 25 years were not very happy with that, remembering that the 5 years before that 25 years started, the market compounded at over 25% a year. So people have not been getting what they signed up for 25 years ago. Now, here's the new information. I just think this is such a great way to understand the difference between value and growth and its impact on the portfolio. Most people probably know about what they call the equal-weighted S&P 500. Right now, if you buy the Vanguard or any of the traditional index Vanguard S&P 500 funds, you're going to get 500 companies, and most of that portfolio is going to be represented by 10 of those 500 companies because they are cap weighted. And those handful of companies have had a huge impact on this last market run. That is not unusual to have a handful of companies having a huge impact, but they come from different, sometimes historically it was energy. Sometimes it was, in fact, technology. As you may remember, technology had an amazing run in the late 90s. So what do we know? So what we know is that there really is an overweighting to growth in the S&P 500. So if you had owned the S&P 500 instead of cap weighted, equally weighted, so that every one of those 500 companies had exactly the same amount of money, how would you have done over the last 25 years? Well, it was better than 8, was 9.4. 9.4. How is it possible? Well, it's possible because it turns out over the 25 years that smaller companies did better than larger companies as a group, and value did better than growth as a group, but you're not going to recognize the names of the companies. But there are 500 companies in RPS. It's the Invesco equal-weighted S&P 500. And the odds are that you will long-term get a better rate of return if you want to be in one S&P 500. But I'm going to warn you right now, you're not going to see you're not going to like what you see, because you're going to go look at Morningstar. How did they do over the last 10 years? Well, because they're weighted through the broad market, which, by the way, is kind of what people think they're getting when they get the S&P 500. But you didn't get a great return because of the broad market. You got a great return because of some technology companies. And by the way, I'm going to give you one other number that blows me away. And that is that the technology index, which had done great until 25 years ago, it had compounded at over 18% a year for 25 years. That has compounded at 8.1% over the last 25 years. I mean, so what do we do with that? I mean, this is the problem we have as investors. Do we get up in the morning and say, how have I been doing lately? Or do we ask, how have I been doing over the last 40 years? I don't even check to see how I'm doing. Once a year, my wife and I take 5% of what we have that we're going to use during our retirement. There's a pool of money. That's what it's for. There's other money that's for others. But that's for us to live on and have fun on. And we even give 30% of that away. So we got more than we need. I'm happy. But what happened last year only matters because I'm going to take 5% of whatever the year-end value of the portfolio was. That's it. That's our magic formula for income in retirement. 5% one day a year. And so I think that this idea of, well, and by the way, not so different than the way I ran my business. I didn't really look at all the little numbers till the end of the year. How did we do? Because if I start trying to make judgments about my business on a daily basis or monthly basis, I'll be chasing my tail forever. And every part of our life is so random. To think that you're going to make sense out of the future from looking at a little slice of your random life, I think that's a huge mistake. And I tell when I'm talking to the college kids, I tell them, you have no idea what you're going to end up with. I was married at 19 before I graduated from college, and I had all sorts of plans. I could see the future well. And I got out of college and got the job of my dreams. And after 3 years, I realized that I was in a terrible position. I did not want to be a stockbroker. There was a conflict of interest in that business that I just couldn't live with it. In fact, I was even told by people in the industry, when the market is up, you just sell as hard as you can sell, because that's when you're going to make your money. Because when the market is down and it would be good for people to buy, they won't buy. So you take advantage of them when they are psychologically most able and willing to put money in. And that's the truth, by the way. And Wall Street plays on that and sells returns like they're meaningful. And of course, some return has to be meaningful or else we couldn't do anything. So that's my little piece of wisdom, and it's what I live with.
The data that you shared is astounding, right? I mean, I feel like the two-fund portfolio that you talk about, when I look at the data, I mean, it's evident, right? I think, that 0.8% return, that extra return that you can get, when you add small cap value, that's astounding. So let's say for young investors, we have been talking about young investors. So how can they start implementing this small cap value into their portfolio, right? So what asset allocation, like, is it 90-10, 80-20, or like, even I see that you mentioned not all the small cap value are the same. So how can we start picking the right ones?
Here's what I know: the people who run. I'll give you a couple of ticker symbols. AV, UV is one. The other is DFSV. One is managed by Avantis, and the other is managed by DFA. These are not the only two mutual fund families that are impacted by academic evidence, but they're the two that I know intimately. And I can't know because I've worked with these people virtually. Well, with DFA, I've had money there since the early 90s. And so I know a lot about how they work, and I've been through their indoctrination program. I mean, remember, this is always at the end of the day about what you believe. And again, I got to highlight, there's no risk in the past. We always know what we could have done. It's all in the future. And so here's what I know about the past. The way they manage is they do not tell people what small cap values companies they have in their portfolio. So nobody knows when they're buying one or selling another. They do not wait to reconstitute for a magic date once every 6 months or once a year. They will reconstitute when they want to, and they actually look at their portfolios on a daily basis. Now, having said that, I don't want to suggest that they would in fact be trading on a daily basis in and out, but they're going to look at the whole portfolio and track them the way they do systematically. It is a mechanical approach, just as an index fund is, but the government, U.S. government, actually calls them on their investor.gov site non-traditional index funds. That's the term they use for them because they are passively managed in the same way, but the changes are made differently than the cap weighted. And they don't have to cap weight. They could have equal weighted if they...
Yeah, I'm going to display all of them in my show notes and also on the screen as well. You have a beautiful, the best ETF recommendations. And I see, as a matter of fact, even I, after reading your work, after going through a website, I invested in AVUV. So my Roth IRA, my IRA is in AVUV, both mine and my wife's, based on the work that you do. So I believe we should totally do a podcast, part 2, just to talk about, we only talked about 2-fund portfolio, and with respect to time, I think, for 4-fund portfolio, we'll have to go do a part 2 for that. So love that. So we are getting towards the end of the conversation, and there are 3 questions that I ask all my guests. I call them the Hotseat Questions. Are you ready for this?
I am.
All right. So the first question is about taking action. So the compounding project is all about taking that first step of action for that compounding to kick in. So what one small action would you recommend people take right after listening to this conversation?
Well, what I would hope, and I'm talking now about the thing that most likely guarantees a better financial future. I hope that if you haven't, you will immediately start paying yourself first. Invest, and let me quote Warren Buffett, don't save what's left over after spending, but spend what's left over after saving. I really want you to set it up so that your life is left learning to adjust. It's the best way of budgeting I know, and it works. And by the way, there are studies that show that it has had the biggest impact on people saving more money of anything that has ever happened to the 401k industry was when they put people automatically into the 401k and made them opt out. And they went from about 25% of the people investing to over 80%. And that's all it took. It's amazing.
Right. I mean, that's the power of, I think, by default, they put you in like 5%, if you don't opt in. And it's incredible, right? I would say like painless way to save money, like, just automate everything. And then, I love that quote, love that advice.
And by the way, if I could add something there. Yeah. You can explain to your spouse the reason you're not taking home more money is because you're saving for their future. I mean, there's going to be a reason that you're making less money, and it's in your best interest.
So books are an integral part of the compounding project journey. So what 3 books would you recommend people read after listening to this stuff, like when it comes to like saving and investing, like 3 books?
Well, certainly, I think since almost every expert says that the biggest hurdle we have, where the most mistakes are made, are emotional mistakes, psychological, the what we call bad behavior. And I think anything that can help change that behavior is going to be positive. And if you don't understand the reasons for that bad behavior, I encourage you to read Jason Zweig's Your Money and Your Brain. And Housel has the psychology of money. That's what they're about. Now, I would mention, I'm not going to recommend, I'll mention a book. It's called Thinking Fast or Slow, or End Slow. And it's by Daniel Kahneman. It's 500 pages long, and it's half of it's readable, and the other half is done by an academic. And so here's what I know the book does. It introduces people to about 40 plus biases that we have. And people don't know it, but almost every one of those biases can be translated into reasons that you will have bad behavior. And so you have to learn, I think, about those biases. Now, 500 pages or even 250 is a lot to ask. So here's what I'm going to recommend. There's a book entitled, and it's free, entitled Spending Your Way to Wealth. And if you wish to ignore the first 200 and some pages, you can, except I can tell you the last 16 pages are I think, 8 biases of Kahneman's work, 16 pages. So if you want to quickly read those biases, that's how you can read it. And each of our directors have written a book that's free on our site. And that book was written by Paul Hayes. And it's a PDF of that book is free on our website. So I recommend those 3 books.
I love that. I mean, so Psychology of Money and Thinking Fast and Slow, those 2 books keep coming, very often on this podcast. So I'm going to link all of them, and also the book that you just mentioned. I love that. So the last question is regarding a hack. So what is your favorite money hack?
I think probably the thing that is going to help people be more successful is to put everything on automatic. Saving on automatic, spending on automatic, all of it. Rebalancing on automatic, dollar cost averaging on automatic, buying more when the market's down on automatic, literally everything, if you can put it on automatic. And the reason I think it's so important is because as much as we know about money to be successful today, the industry that wants you to spend is spending a whole bunch more money on them getting you to spend. In other words, they want you to stop that automatic savings, stop all of those things that are benefiting you and your family and your financial future, and put your money where they want you to put it. And I don't know a better way to do it than putting everything you can on automatic.
I love that. I'm a huge fan of automation. Like I automated everything, and then spend your time on the stuff that you love. All right. With that, Paul, thanks a lot for your time. It's been a pleasure to have you on the podcast. How can people learn more about you?
Well, they can come to paulmerriman.com, and if they really want to get serious, they're going to open up the page. It's called Boot Camp, and there are about 9 really important $1 million decisions that we talk about there, and do an audio and an article and a video on each one of those. And if you want to do me a favor, I get paid nothing for what I'm doing, and I love it, by the way. This is not a complaint I'm making. I'm not asking for a raise, but I am asking for one thing you could do to help me. And that is the book We're Talking Millions, 12 Simple Ways to Supercharge Your Retirement. That is a PDF that is free on our website. And the reason it is free is not because I wouldn't like to have the royalty from Amazon go to our foundation, because I don't make any money from the foundation, but because you can then forward it on to friends and family at no cost to you and no cost to them. And maybe even you'll find a chapter that's really special to you and you think it would help one of your children. Highlight the chapter. Do something to get them to read one part of it in the hopes that they'll read the whole part. That's what would make me happy.
But again, thanks a lot for all the work that you do. I can only see how much passionate you're about this topic, because at FinCon we spoke for more than 1 hour, and now we're close to 2 hours. And I can't believe how you can remember all those numbers, years, numbers, percentages. It still surprises me. But I'm going to link that book. You're talking about, we are talking millions actually. I downloaded that. I read that book. I loved it, and I'm going to recommend that to my friends and family, and then my subscribers as well.
That's great.
Yeah. With that, Paul, thanks for your time. It's great to have you on the podcast.
And thanks so much for the work that you're doing. We really appreciate it.
If you found value in this episode, then please don't forget to subscribe. Until next time, trust compounding and take action now. Thank you so much for watching or listening. If you enjoyed this episode, can you do me a quick favor and hit that subscribe button? If you like this episode, then you might enjoy this episode, which links in with some of the stuff we talked today. Thanks for watching. I'll see you next time.